Imagine waking up one day without worrying about money. No stress about bills. No fear of emergencies. No confusion about where your income goes every month. This isn't about becoming rich overnight. It's about building financial confidence step by step. Personal finance and investing are not just numbers, they are life skills. And the earlier you understand them, the more freedom you create for your future. In this audiobook, we'll explore how money really works, how to manage it wisely, and how to make it grow over time through investing. You don't need to be an expert. You just need the right mindset and a few simple principles. Let's begin. Chapter 1. Understanding Personal Finance. Personal finance is simply how you earn, spend, save, and plan your money. Think of it as the foundation of a house. If the foundation is weak, nothing built on top of it will last. Income. Income is the money you receive through a job, a business, or other sources. The key thing to remember is this: it's not about how much you earn, but how well you manage what you earn. Many people with high incomes still struggle financially because they don't control their spending. Expenses. Expenses are where your money goes. They usually fall into two categories: needs, food, housing, transportation, education; wants, entertainment, eating out, gadgets, luxury items. The goal isn't to eliminate enjoyment, but to balance spending so your future doesn't suffer for short-term pleasure. Chapter 2. The Importance of Budgeting. A budget is simply a plan for your money. It tells your money where to go instead of wondering where it went. Why budgeting matters. Budgeting helps you avoid unnecessary debt, save consistently, reduce financial stress, and prepare for emergencies. One popular budgeting approach is the 50-30-20 rule. 50% for needs, 30% for wants, and 20% for saving and investing. Even if you can't follow this perfectly, having any plan at all is better than none. Budgeting isn't restriction, it's direction. Chapter 3. Saving Money the Smart Way. Simple explanation. Saving is what turns your income into security. It's the habit that protects you when life doesn't go as planned. Think of saving like a safety net. You hope you never need it, but when something goes wrong, you're grateful it's there. Emergency fund, your financial safety net. Before you even think about investing, the first step is building an emergency fund. An emergency fund is money you keep only for unexpected situations, such as medical bills, car or home repairs, suddenly losing your job or income. Life is unpredictable. Emergencies don't ask for permission before they arrive. That's why financial experts recommend saving 3 to 6 months of your basic living expenses. This means if your monthly expenses are $1,000, your emergency fund should be between $3,000 and $6,000. Why is this so important? Because when you have an emergency fund, you don't panic, you don't rely on credit cards, you don't go into debt. It gives you peace of mind and time to make smart decisions instead of rushed ones. Saving versus investing. What's the difference? Many people confuse saving and investing, but they serve different purposes. Saving is about keeping your money safe and accessible. You usually save money in a bank account where it doesn't change much in value. Saving is used for emergencies, short-term goals, and financial security. Investing, on the other hand, is about growing your money over time. When you invest, your money is placed into things like businesses or assets that can increase in value. Investing is used for long-term goals, wealth building, beating inflation. Why you need both? You can think of it this way.
Saving is your shield. Investing is your engine. Saving gives you stability and protection. Investing gives you growth and opportunity. If you invest without saving, one emergency can force you to sell investments or take on debt. If you save without investing, your money stays safe, but it doesn't grow much. The smart approach is balance. Save first to protect yourself, then invest to build your future. That's how money works for you, not against you.
Chapter 4. Understanding Debt. Debt means borrowing money that you must repay later, usually with interest. Debt itself is not always bad. What matters is why you're borrowing and how it affects your future. Good debt, debt that helps you grow. Good debt is money borrowed to improve your future earning ability. Examples include education that helps you get a better job, skill development like courses or training, starting a business that can generate income. This type of debt can be useful because it has the potential to increase your income over time. In simple terms, good debt helps you move forward. Bad debt, debt that holds you back. Bad debt usually comes from spending on things that lose value quickly or don't improve your future. Examples include high-interest credit cards, impulse purchases you don't really need, lifestyle inflation where spending increases just to look successful. Bad debt is dangerous because interest keeps growing and you end up paying much more than the original cost. The real danger of bad debt is that it steals money from your future. Money that could have been saved, invested, or used for goals instead goes toward paying interest. It limits your freedom and creates stress. The smart strategy for debt. The best strategy is simple and powerful. Avoid unnecessary debt and pay off high-interest debt as quickly as possible. The less debt you have, the more control you have over your money and your life.
Chapter 5. What is investing? Investing is the process of putting your money into things, called assets, that are expected to increase in value over time. Instead of letting your money sit unused, you allow it to work for you. Think of investing like planting a seed. With time and care, it grows into something much bigger. Why investing matters. If you keep money only in savings, its value slowly decreases because of inflation. Inflation means prices go up over time, and money buys less than it used to. For example, what costs $100 today may cost $120 in the future. Investing helps your money grow faster than inflation, so your purchasing power is protected. Time is your biggest advantage. The most powerful factor in investing is time. The earlier you start investing, the more time your money has to grow, the less money you need to invest overall. Even small amounts can grow into something meaningful if given enough time. Starting early is not about being rich, it's about being consistent. Key takeaway. Debt should be used carefully and intentionally. Investing should be started early and patiently. Avoid bad debt that limits your future. Use investing to build long-term security and freedom. Money grows best when you give it time, discipline, and purpose.
Chapter 6. Types of investments. Let's explore some common investment options. Stocks. Stocks represent ownership in a company. When the company grows, your investment can grow too. Stocks can be volatile in the short term, but historically they offer strong long-term returns. Bonds. Bonds are loans you give to governments or companies. They're generally safer than stocks, but offer lower returns. Mutual funds and ETFs. These combine many investments into one.
They offer diversification, lower risk than individual stocks, and simplicity for beginners. Real estate. Real estate can provide rental income, long-term appreciation. However, it requires more capital and responsibility. Chapter 7. Risk and Reward. Every investment involves risk. Risk means there's always a chance that the value of your investment can go up or down. The goal of investing is not to completely avoid risk. That's almost impossible. Instead, the smart approach is to manage risk wisely. Diversification. Don't put all your eggs in one basket. Diversification means spreading your money across different investments instead of putting it all in one place. For example, investing in different companies, investing in different industries, using multiple types of investments. Why does this matter? If one investment performs poorly, the others can help balance the loss. Diversification protects you from big setbacks and makes your investment journey smoother. Risk tolerance, knowing your comfort level. Risk tolerance is how much risk you can emotionally and financially handle. It depends on your age. Younger people usually have more time to recover from losses. Your income. Steady income allows more flexibility. Your goals. Short-term goals need lower risk. Long-term goals can handle more. Younger investors can often take more risk because they have time on their side. Older investors usually focus more on protecting what they've built. Knowing your risk tolerance helps you invest confidently, not fearfully. Chapter 8. The Long-Term Mindset. Successful investing is often boring, and that's a good thing. Big wins rarely come from excitement or quick decisions. They come from patience and consistency. Trying to predict market movements or chase the latest trend often leads to mistakes and losses. What works instead? A smarter approach is simple. Invest regularly. Stay consistent even when markets fluctuate. Think long-term. Markets naturally go up and down in the short term, but over long periods, they tend to grow. The power of compound growth. Compound growth means your money starts earning returns, and then those returns start earning returns too. This process takes time, but it's incredibly powerful. Even small amounts invested consistently can grow into something meaningful over many years. Patience is not slow, it's strategic. Chapter 9. Common Financial Mistakes to Avoid. Let's talk about some mistakes that hold many people back financially. Spending more than you earn. This creates constant financial stress and leads to debt. Living within your means gives you control and freedom. Ignoring budgeting. Without a budget, it's easy to lose track of money. A budget gives direction and clarity. Investing without understanding. Putting money into things you don't understand can be risky. Always learn the basics before investing. Letting emotions control decisions. Fear and greed cause people to buy high and sell low. Staying calm and disciplined leads to better outcomes. Waiting too long to start. Many people delay investing, thinking they need more money, but time is more important than amount. Final reminder: the cost of waiting is often higher than the cost of starting small. Start where you are. Use what you have. Be consistent. That's how long-term success is built. Chapter 10. Building Financial Discipline. Financial discipline is the ability to make smart money decisions consistently, even when you don't feel motivated. Motivation comes and goes. Discipline stays. That's why discipline matters more than motivation when it comes to money. Why habits are more powerful than effort.
Many people try to manage money using short bursts of effort, saving for a few weeks, then stopping. But real financial success comes from small habits done repeatedly over time. Good habits may seem boring, but they quietly build strong results. Simple habits that make a big difference. Tracking expenses. When you track your spending, you become aware of where your money actually goes. Awareness alone often leads to better decisions. Automating savings. Automating savings removes the need to think or decide. Money is saved before you have the chance to spend it. Reviewing goals regularly. Checking your goals reminds you why you're saving and investing. It keeps you focused and motivated over the long term. Consistency over perfection. Financial success doesn't require perfect decisions. Everyone makes mistakes. What matters is staying consistent. Missing a day or a month doesn't ruin progress. Giving up does. Small, repeated actions done over years create stability, growth, and freedom. Final thought. Discipline turns plans into reality. Habits turn effort into results. Stay consistent, stay patient, and trust the process. That's how financial discipline builds a strong future.
Conclusion? Your financial journey, or your personal finance, or your investing, are lifelong skills. You don't need to know everything today. You just need to start. Every smart decision, even a small one, moves you closer to stability, independence, and freedom. Money is a tool. When used wisely, it creates opportunity. When ignored, it creates stress. Your future is shaped by the choices you make today. Thank you for listening, and remember, the best investment you'll ever make is in yourself.